going to discuss how to navigate a deal with a private equity fund and be successful. Give you a bit of background on myself. I'm a managing director. I run the Tampa team, the Tampa transaction team. And before I get too deep here, also with me is Wade Duncan, who will be here all along fielding your questions. So if you have questions along the way, feel free to send them and we will get to them at the end. So please do ask liberally and we will try to get to all of them. My background is a bit nuanced. I've spent time on both sides of the aisle. So I've been a buyer, I've been a seller, and now I've spent a number of years in the middle helping to facilitate deals. So I think I've got a pretty unique experience to understand how buyers see the world, how private equity buyers see the world. And I think we have quite a bit of that. I've hired that as well. We have folks here who worked for private equity funds, running portfolios, running our teams now. So we do have a pretty unique view on how to navigate a deal with a private equity fund. And that's what we'll talk about today. Okay, so I'm sure most of you have heard quite a bit about private equity funds. We all learn through experience, but we also learn by listening to the folks around us. Some of us have read books, very famous books about the private equity world and how they do deals. Very famous one, Barbarians at the Gate, detailed KKR's acquisition of Kraft Nabisco. You may have heard of that one. And I think that legacy, that deal was 30 years ago, still continues to this day. And I think it does, in some regards, dictate how most or many sellers view the world as it relates to private equity. So we want to talk a little bit about what you've heard. One of the key things that I hear from our clients every day, and I do talk to our clients every day, is that these guys are just finance guys. These guys are bean counters. They'll never understand my business and they don't care to. We also hear that they're going to load up the company with debt and then pay themselves a big dividend and crater the company. So hear that all the time. We also hear from them that as soon as they take over, they're going to fire maybe not all of my employees, but a lot of my employees that they view as just overhead. They're going to cut costs, try and maximize profit for the short term, pull money out, and then move on. That's one we hear fairly regularly. And the one we hear maybe more than any other is that they're going to change how I run my business. I've run this business for decades, and my father before me, and they're going to come in with their ideas on how it should be run, and they will dramatically change the business and in a way that will impact the performance, and any of the employees that are left that they haven't fired will likely lose their job because the company will crater. These are the perceptions that we've often heard when we're talking to our clients. And again, we talk to our sell-side clients every day. Okay, we're going to talk a bit about why you've heard what you've heard. I referenced the book earlier, Barbarians at the Gate, detailing a very famous story. That was in the 1980s, 1989. In the 80s especially, and really into about 15 or 20 years ago, these LBOs, as they were called, leveraged buyouts, really featured a unique debt to equity structure. Many of those deals were 90% debt, right? So they leveraged their own balance sheet and they leveraged the balance sheet of the target company to acquire that business and saddle it with massive amounts of debt. What that did was it required them to come forth with very little equity and really just massively overweight the debt on the business. That was a recipe for disaster. And many folks in the lower middle market have heard of these stories, and they view that that is still what's happening. And we'll talk a bit about how that's just not the case anymore in the next slide. Also, one interesting point about private equity is that there was a point in time until roughly 8 or 10 years ago where there was very little private equity money out there, and corporate balance sheets weren't as replete with stores of cash as they are today. What that did was it created a scarcity of resources or money. Today, actually, we have the inverse. We really have a lot of money chasing very few deals. But back then, there were very few folks who were capable of pulling together a transaction. And because of that, that creates power. The folks who have the scarce resources always have the power. And back then, they had quite a bit of it. And that really helped them to develop a bit of an attitude. They were known as pretty pompous and pretty prickly, and those reputations were well earned. I don't know that that's the case today, but some of those reputations do prevail many decades later. And there was, especially in the LBO environment, there was an incentive to really financially engineer a profit. And what that meant was coming in and looking for ways to cut costs pretty aggressively. And obviously, most businesses, almost every business, the highest cost in a business is the headcount. So there was a time where private equity funds did massively decimate the employee pools. And that may not be the case today, but that actually was a thing that happened, and I think that reputation still survives to some degree. And the other piece, which is actually just a thing that happens pretty much in every deal that involves a private equity fund, whether it's a legacy deal or one that happens today, is funds tend to be very, very rigorous in their due diligence, especially their financial due diligence. So because of that, and we'll talk a bit about the gap between what a buyer expects and what a seller can provide quite a bit later in the presentation. But this is really where it rears its ugly head. And the financial due diligence is again, very, 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 very aggressive. They will do a quality of earnings. They'll engage a regional or national accounting firm to dive pretty deep into your financials. They'll go into the general ledger and track individual transactions, maybe 20, 30,000 lines. So it's sometimes hundreds of thousands of lines. So it's a very, very rigorous process. And it tends to be pretty off-putting for most sellers in the lower middle market. So that's why that reputation actually exists. Let's sort of compare and contrast that against what we're seeing today. I think I set this up a little bit by showing you that today there are lots of dollars chasing very few deals. Now, perhaps the amount of deals has not gone down, but the folks with access to capital, both in private equity and also in the corporate world, is massive. So because multiples have really skyrocketed over the course of the last probably 8 or 10 years, a lot of buyers have really been on the sidelines. But they have a mandate to deploy capital. Private equity funds do. If they don't put money to work, there is a useful life of a fund. That money goes away, and it makes it much more difficult to raise the next fund. Obviously, if you haven't put your last fund to use, you don't have a track record, you don't have an IRR, it's very hard to market for a new fund. Why would I give you more money? You haven't spent the money I gave you. So they certainly have an incentive to put money to work, and corporate balance sheets are just flush with cash. So it's a really different reality today. Now, these guys tend to be financial people. Most of these men and women at private equity have gone to very prestigious MBA programs. You see Wharton quite a bit. You'll see Harvard. You'll see all of the big names. But also, they're not just bean counters, as we've heard often. What they are is folks who often will have a strategic interest in a specific sector. So they might have hired someone who has exited their company, and they have, let's just say, a healthcare focus. And perhaps one of their newer operating partners sold a business that's an orthopedic products manufacturer. Say, we'll call it inserts for shoes. Because of that, because they have a keen interest in that industry, and they have an operating partner that's been successful in that industry, they go deep. They learn quite a bit about it, and they target companies in that very specific subsector. So they get pretty smart on it. So they're not just finance folks. They tend to be pretty engaged and pretty strategic. We talked about putting debt on the balance sheet, talked about using debt to help buy the company. We're in a really historically low interest rate environment. And because of that, there's tremendous incentive to go and use debt as a portion of the transaction. It just makes sense if you can borrow money at 4, 5, 6, 7, 8%, and your cost of capital from an equity perspective is in the 20s. It makes a lot of sense to use as much debt as you can. But they're also, because they really want to grow the business, they don't have incentive to overburden the business with debt. They need to grow. So they need to maintain enough money to grow the business. So they don't have incentive to put too much debt on the balance sheet, but they do have incentive to use debt to some degree. So I would expect that almost every deal with a private equity fund does involve debt. Key employees tend to be not just retained, but they're actually offered employment contracts. It's very unlikely today that they have an employment contract with your business. I don't have one. Most folks do not. So they actually should feel even more protected post-closing, because they're likely to get an employment contract, and it may even be a condition, it likely will be a condition of closing, that they're able to lock up these key employees. So that whole mantra, the notion that your employees will be eliminated day one, it's actually quite the opposite. Most buyers will not do a deal. Private equity buyers will not do a deal unless they can get assurances that they can lock up your key people, and really they tend to retain everybody. That's an important distinction. The notion that they're going to change the way you do business every day, it's largely unfounded. They tend to identify the operational line and stay above the line and not really ever go below that line. Their role tends to be board level. They bring a Rolodex, they bring money for future add-on acquisitions. Also, because they do this every day for a living, they have a team in place where they can execute on add-ons. And with your help, identifying good targets, that is a big part of what they can do. So they bring really strategic guidance, but they're not here to make day-to-day decisions for you. That's really for you to do. And they generally will expect you to stay on to some degree, and they're there to help. So that's a real misconception. We're not seeing that today, and want to make sure we point that out to you. One of the key considerations and why you should really consider working with a private equity fund potentially in a process is that one of the things we see that kills deals more than anything is lack of funding, especially in the lower middle market. These deals are hard to fund. If someone wants to go and buy a company on their own, it's very hard for them to raise the amount of money they need to buy the business, the debt and the equity, unless they've got the equity in their personal stores. So a private equity fund, they go out and they raise pools of capital. It's there, it's committed. They can draw it down as they need it, and they generally have several banking relationships where the banks will essentially rubber stamp their due diligence. So funding is rarely an issue in a private equity deal. So that's a really important distinction. And the other distinction that I tend to see in almost every site visit I've been to with a private equity fund is that the culture remains intact post-closing. We hear them sort of compare and contrast that to a strategic buyer. And a strategic buyer might come in and say, you know, the way you bill, the way you track your hours and bill your customers does not map to how we do it. We think that's wrong. We think you should do it our way. Well, perhaps you have a service culture, right? And your entire culture revolves around how you treat your customers. And perhaps what they say is every customer concern is addressed. And we may not bill every single last dollar, right? But it's about preserving that customer. It's about that cost of customer acquisition and about creating stickiness. We want to make sure we keep our customers. And if you come in and make that major change to our revenue model, that can impact culture. And we don't see that in private equity. Private equity, because they stay above the line and don't dip into operations, they tend to allow cultures to remain intact. That's really an important distinction. When mergers and acquisitions fail post-closing, it's often because at least of culture. They're not able to integrate the cultures. Let's just move on. We talked about this a little bit on the front of the process here, that expectations of what a buyer, especially a private equity buyer, requires and what a seller is able to provide, there's a tremendous gap there. And let's just talk a bit about what private equity buyers expect out of a seller. They expect financials to be prepared in accordance with GAAP, generally accepted accounting principles. They expect a balance sheet that's got accruals for every potential deferred expense, one that's not known, one that's not incurred yet. They expect you to accrue for all of your PTO and for bonuses and all the like. We don't often see that. They expect robust financial systems and reporting systems that are able to spit out dashboards and specific reports that answers every question that they have. They also expect full year and often multi-year financial forecasts. And they expect rigorous financial controls to be in place and to have a key finance person on staff. And a true finance person, a CFO, a controller, a VP of finance, someone who's in charge of the whole finance function of the organization. Let's map that to what sellers are able to deliver. And again, we speak from the experience of working with hundreds of sellers. We close more than 100 deals every single year. So we have a tremendous amount of experience working with sellers because we only represent sellers. Our sellers, and if you think they represent a large swath of the market, they have generally non-GAAP compliant financials. Many of them are still on a cash basis. If they're on a cash basis, they can't match, and because of that, they're not GAAP compliant. Even ones that are partially GAAP compliant generally are missing many of the accrued expenses on the balance sheet. So we don't often see sellers that are able to put forth a GAAP compliant set of financial statements. It's an important distinction to keep in mind. They also tend to have financial accounting systems that are either ad hoc, they've built it themselves over the course of time. Sometimes we've seen it in Excel, in Word, and sometimes it's very industry specific. One of the challenges there, especially for buyers, is that sometimes they have multiple systems. So they might have a billing system that doesn't speak to the accounting system. They might have an inventory control system that doesn't speak to the accounting system. So they have to do monthly adjustments. They often do, monthly inventory counts, and they have to make manual adjustments. That's not something buyers expect to see, but it happens in almost every deal. Our clients also very infrequently have a forecast, a true forecast of the next year, much less the next 3 years. And what gives them visibility into subsequent years is their pipeline, their aging reports, their WIP reports, those kinds of things. And from there, they can sort of infer what their cost basis will be. So they have a good feel for what next year might look like, but they haven't built out a financial forecast. That tends to throw private equity buyers for a bit of a run because they do expect to see something a little more robust than that. And our clients don't tend to live off of dashboards, and they don't tend to have financial controls in place. They don't have multiple folks signing off on checks over $1,000. They don't tend to have those kinds of controls and procedures in place. They've run their business really the same way for 30 years, and they haven't put that sort of professionalization into the process. Bookkeepers are rarely CFO level folks. They tend to be, often is the case, the spouse of the founder, and they've evolved from someone who did all of the billing and all of the AR, so all the payment of bills, and they evolve into the senior financial professional in the business. So they rarely are capable of answering the questions that a CFO would be able to answer because that's just not their training. They're quite good at their current role with the business, but probably can't scale and probably can't add the layer of professionalism and controls that a buyer in the private equity world would expect. So the gap is obvious between what's expected from a private equity fund and what a seller in the lower middle market is able to provide. So how do you bridge that gap? Well, really at the onset, when I say the onset, I mean at the execution of the letter of intent, you need to level set expectations. Buyers and sellers need to understand where each other is coming from. A buyer may really expect to see GAAP compliant financials, but if they're not compliant, there's no easy way to make them GAAP compliant. So there needs to be a common understanding and a common language. So if a buyer is asking for specific reports, instead of asking what the actual underlying question is, right? Rather than asking for an AR aging report, perhaps the buyer can phrase it in a conversation with the seller that says, I'm just trying to understand because I know in this industry, a lot of companies struggle to collect on their accounts receivable. And we're curious to see if that creates a bit of a cash flow issue for you. So because of that, we want to see your AR aging report. We want to see between 60 to 90 days and 90 to 120 days, because you can't tell me what your average collection is. Well, perhaps the seller actually has another way of illustrating why their collection is what it is. And perhaps he can show that 100% of that AR historically is collectible. They have no bad debt. And perhaps they have another methodology to ensure that they don't have, these lapses in cash flow, that they're able to meet their obligations. And they use a different report to address that. So when buyers speak about reports, they need to translate that because there's an underlying question. The report's there to ask a serious question. And if you ask the actual question rather than asking for a report, you tend to get on the same page with the buyer and the seller. So one of the key ways to do that, obviously, is to have an advisor, especially on the sell side. So buyers, especially private equity buyers, they're set up to buy companies. This is what they do. They understand the process. They know that there are ups and downs. What they need on the other side is someone who's either a very experienced seller or someone who can help that seller navigate the process. So it's really important, not just for the seller to have a representative on their side. It's actually important for the buyer that the seller has a good representative on their side, so they can really create a common understanding, a common language, and both sides have to be willing and able to learn. They have to be open to the notion of changing their process a bit to try and address each other's concerns and questions. So we're going to pivot here a bit, discuss private equity math. Private equity math is very, very complicated. We talked about how these folks went to sophisticated MBA programs. Almost all of them graduated from a top school. While they're not just bean counters, the math is very sophisticated, and it does come up in a number of different places. The first we're going to talk about is net working capital. We're going to define net working capital, talk a bit about how it deviates from net working capital in mergers and acquisitions and why it's important. We're also going to talk about leverage. Leverage is essentially acquisition debt in this context, and we'll talk about how that impacts the rollover equity. Rollover equity is when a seller maintains a piece of the business after the closing. And in most private equity deals, we do see the seller being required or asked to roll over a piece of the business going forward. We'll talk a little bit about valuation. We're not going to spend time actually going through one, but we're going to talk a little bit about some of the inputs into evaluation. Buyers are going to do a discounted cash flow. A discounted cash flow is essentially plotting out and mapping out the future series of cash flows generated by the business plus a terminal value, and then bringing it back to today's dollars at a certain interest rate or cost of capital that they use. That cost of capital can be a blend of their cost of debt capital and cost of equity capital. It's called the weighted average cost of capital. They may use another hurdle rate that they use. But what it really means is it's a fairly complicated series of formulas, although it can be done in 15 seconds in Excel these days. But it's a fairly sophisticated system with some important inputs, and part of it is obviously your series of future earnings. They're going to scrutinize your add backs. What are add backs? Well, as an owner of a private company, you may funnel some personal costs through the business. You may pay for all of your children's cell phone bills. You may give them a salary in the business, even though they're not operational. This happens in a very large percentage of lower middle market businesses. It's not something that we see 5 or 10% of the time. It's something we see probably 90% of the time. So add backs are a part of the world where we just take EBITDA and we normalize it. What will EBITDA be if someone else is owning it? Are they going to continue to pay for your children's private school through the business? Probably not. That's an add back. But they're going to scrutinize it. We see there are certain areas where they'll look very, very deeply. So if you were to execute on a growth strategy where you're building perhaps a new product or service, maybe entering a new geography, there are startup costs. And we tend to see those one-time costs as an add back. But sometimes buyers are saying that's just ongoing cost of doing business. If you want to grow, you've got to make those investments, and that's not an add back. So they will push back on a lot of the add backs, and we'll talk a bit about why a little bit later. And there are other factors that will impact valuation other than EBITDA. Growth rates is really important, and cost of capital, obviously we talked a little bit about that as well. Now, one thing to really keep an eye out for is when you stretch a seller, and when you say stretch them, that means when you bring them beyond their comfort level. Let's just say that they've offered you a 6x multiple, and let's just say for the kind of industry that you're in and in the size range that you are in, you generally see, let's say 4 to 6 times as being market. If you get them to 6.5 or 7, you've stretched them probably beyond their comfort level. If they still proceed with the deal at that higher valuation, they will likely be looking for ways to claw back some of those dollars during due diligence. And there's 2 primary ways where they can do it. One is through net working capital, and the other is through their quality of earnings, where they will get a report and they will look at your EBITDA number and look for ways to reduce the EBITDA that was agreed to. So it's really important to keep that in mind. This is where having a really strong sell-side advisor on your team is absolutely critical. Okay, so let's dive in a bit into working capital. So working capital, as you learn it in your undergraduate work, I think my first course at Lehigh was accounting, and we learned the definition of net working capital. Net working capital is just current assets minus current liabilities. It's a measure of liquidity. It's a measure of a business's ability to maintain operations, to fund short-term obligations, to meet payroll, all those things. But in M&A, most deals are cash-free, debt-free. What does that mean? It means that prior to closing, the seller generally will be able to swipe the cash from the balance sheet, pull it out of the account, and put it into a personal account. But they're also generally required to pay off any indebtedness, long-term debt, even a line of credit. So because of that, we don't use cash in the calculation of net working capital for the purposes of an M&A transaction. The predominant drivers of working capital in the analysis are accounts receivable, inventory, and accounts payable, where the formula is accounts receivable plus inventory minus accounts payable. So if the seller is actually accruing for all the things we talked about and more, then those are generally incorporated, but some of them may not be. Just saying accrued PTO. PTO is not really a cash expense, so that we may exclude that from the formula. That's a negotiated item with the buyer. So why is this important? Well, we talked about a bit. This is a measure of your operational health. Can you meet payroll? It's a liquidity measure. But it also helps to determine if you've got the money there to grow, right? You use excess working capital to grow. You might use that to make capital investments. You can also obviously go and borrow money as well, but many of our sellers are averse to bringing on debt to grow. It also can serve as a bit of an operational dashboard, so you can use your net working capital day to day to understand your cash position. Obviously, you have a cash line item, but cash today is not cash tomorrow. Accounts receivable is cash tomorrow, right? So you convert accounts receivable into cash, and that's what you use to pay off your payables. Inventory is future AR, which is future cash, right? So these are really important. One thing you actually can use this is just a bit of an aside, is a large inventory number. It may sound good because it'll raise your working capital. Inventory isn't particularly liquid because you can't necessarily convert it to cash very, very quickly at or close to market value. And if you're holding a lot of inventory while your net working capital is going to be substantial, it might mean that you're not turning your inventory over very often. So it can serve as a bit of an operational dashboard for you, and certainly for the buyer. Okay, so in these deals, often what will happen is we will set a target, a working capital target, or what's known as a PEG. So the buyer and seller teams will get together separately and analyze monthly balance sheets. And you'll go back generally 36 months and look at trends. What does AR look like over the course of that period? What do the payables look like? What does inventory look like? All of the various inputs that are agreed to go into the formula, and you might see some real patterns, right? So if you're doing a valuation based on a trailing 12-month period, if the business is growing massively, that's generally the best metric to value the business upon. You're going to have to likely settle for using that also as the period of time used for the net working capital calculation. On a growing business, trailing 36 months is a much lower number than the trailing 6-month number. And again, you're going to generally line those two up. The trailing 12 used for valuation, trailing 12 will be used for net working capital. Buyers are always looking for a shorter period. They want net working capital, the target, to be as high as possible, so that if there's enough money to continue the growth of the business. Sellers in a growing business environment want to see a much longer period of time incorporated, because that will push the peg down. If you push the peg down, there's likely to be a bit of an excess of working capital at closing, and that would flow through, the excess would flow through to the seller in the way of a gross up a purchase price. We'll get a bit more into that in the next slide. Let's talk a bit about the mechanics behind it. So a few days before closing, the sell side team prepares an estimated closing balance sheet. Generally, it's 3 days prior to closing. It's not done the day of closing because there are a lot of things that need to happen on that day. You tend to be executing a lot of documents. There's escrow. There's a ton of things that are happening. So a few days before closing, you prepare an estimated closing balance sheet. It's estimated because you don't quite know exactly what certain numbers will be. There are numbers, there are checks that are out there in float. There's things that are in AR 3 days beforehand that might actually convert to cash over that 3-day period. So because of that, there's a look back period that we'll talk about in a second. So the buyer reviews that estimated closing balance sheet. They put forth what they believe the actual closing working capital is. The seller does the same. They've already agreed on the formula, so it's a fairly simple exercise, and they compare that against the peg. If net working capital at closing is actually smaller than the target, there is actually a reduction in purchase price by that dollar for dollar. If the opposite is true, if there's excess net working capital, then there is a gross up of purchase price dollar for dollar. So if the target is $20 and there's $27 at closing, generally there's a $7 increase in purchase price, and the opposite is also true. So how does a buyer use that potentially to erode value? So again, as we said, if you stretch them, they're beyond their comfort zone generally, and they will be looking for opportunities to claw back some of that incremental cash. And one way to do it is to take a very aggressive stance on net working capital. Now, we've seen deals swing violently when it comes to using net working capital. Just say you have a business that got 6 times EBITDA, and it's based on $500,000 in EBITDA. So it's a smaller deal. It's a $3 million deal, and let's just say net working capital is a couple $100,000 as a target. We've seen buyers push to claw back $150,000 in net working capital and create a scenario where they erode a meaningful percentage of deal value. That's 5% of deal value they've clawed back. So, they will, again, if you really push them on the valuation, be prepared for them to push back and look for ways to claw back some of those incremental dollars. And net working capital is certainly one of those places. Now, if the discussions have been mostly positive, you have a buyer and seller that have a meeting of the minds, what they'll generally do is get the lawyers to put in a band around the peg. So what that means is they'll put together 5 or 10%, maybe as high as 20, around the target, where if you're short by 5 or 10% or there's excess by 5 or 10%, we call it no blood. So there's no, those small excesses or shortfalls are ignored. And that makes a lot of sense in a deal where you're continuing on being a key driver of the business. There's a real incentive for both buyer and seller to work as partners going forward, and no one wants to reach into each other's pockets if there's an opportunity to really make a lot more money down the road. So we tend to see in deals, especially where there's a really good dynamic between the seller and the buyer, putting a band in place makes a lot of sense in those kinds of deals. But again, I'm going to say this probably for the 4th time. An early win when it comes to stretching a buyer really can put them on alert, and they'll be looking for opportunities to claw that back. So really important to have somebody on your side that's really engaging in these discussions. If we have to be the bad guy, we can do that. But if you have to do it on your own, there's a notion, there's certainly a chance that they might fall out of love, right? Because if you're the one beating them up over valuation and they're betting on you going forward, it can really change that buyer-seller dynamic, that partnership feel. So it's really important to have somebody who knows what they're doing in the middle, kind of fighting for you, but also sort of insulating you from having these very difficult conversations. And as we said, the math is actually quite complicated. This is all, folks like us, this is all we do for a living. So we're really adroit at handling these kinds of discussions and doing this kind of analysis. So I referenced this earlier, the use of leverage in deals. It's just a fact of life. They're going to use debt. Frankly, they should use debt in acquiring a business. Again, cost of capital It's really important for these guys in their formulas to determine valuation and also to determine whether they're going to have a successful fund or not. So they're going to use debt whether you like it or not. But what is really important to know is, where does that debt sit? Does it sit on the company balance sheet, or does it sit somewhere else? Whether it sits with them personally, whether it sits on another entity, does it in any way encumber the balance sheet of the business they're acquiring? Remember, you're going to be likely rolling over a portion of the proceeds into the new company. So this is where it really becomes important. Let's take a very simple transaction. A $10 million deal, 75% of its cash close, and the other 25% is just rollover equity, right? So you get a check for $7.5 million, or a wire generally, and you roll over $2.5 million of equity, and the buyer has brought all of that money out of their fund. It all sits as equity on the balance sheet, and the seller rolls over 2.5. There's still $10 million of equity, and it's a very, very simple situation, right? Let's make it a little more complex. Same $10 million deal, still $7.5 million cash at close, and the seller rolls over $2.5 million of equity. So we're still in the same situation, but here the buyer has borrowed money from the bank, and that debt is attached to a different entity. It's not on the company balance sheet. Now, even though it's borrowed money, it doesn't function as debt in the transaction. The buyer is bringing that. It's not encumbered. It doesn't encumber your balance sheet. It only encumbers them. So despite the fact that it was borrowed money, it actually acts like equity in the transaction. So the buyer still has 75% of the equity, and the seller retains 25% of the equity. And the equity still is $10 million. That might seem a little odd, but it doesn't encumber, that debt does not at all encumber the corporate balance sheet. That's really the important piece. So it doesn't dilute the buyer's equity. Let's take a third scenario here. So another $10 million deal, $7.5 million cash to the seller, $2.5 million of rolled equity. This time the buyer borrows money from the bank, and that debt sits on the company's balance sheet after closing. So in this situation, which is really the predominant approach by private equity funds today, this is what you're likely to see. That $5 million is on the balance sheet of the business they're buying, the business that you've owned forever and you still will own a piece of. It's not buyer equity. They did not bring that as their money. The buyer actually brings the balance. So it's still $7.5 million cash at close to the seller. 5 of that comes from the bank. So that $5 million that they're borrowing goes to you to help that $7.5 million cash at close number. The balance comes from from the buyer. The buyer brings $2.5 million in cash, so does the seller. So the total equity is $5 million, not 10, because it's diluted, right, by the $5 million in debt. So now they're 50-50 partners. You still have $7.5 million cash at close you did in the last deal, right? But in this case, you actually own half the company, not a quarter. So the math really gets interesting. And in this way, this dilution of the buyer, this debt sitting on the balance sheet, actually helps you quite a bit if you're looking to own a significant portion of the business going forward, because now you own half the business and you've been cashed out at $7.5 million. Okay, so where the debt really sits is absolutely critical. Let's take a last kind of scenario here. $10 million deal again. The seller is rolling 25%. The buyer is going to use debt to fund a part of the transaction, a big part. In this scenario, the cash at close goes up by over $1 million. The buyer has brought in $4.285 million in equity and the same in debt. And that goes entirely to the seller at closing. The seller's roll is actually now reduced to $1.43 million. They've actually only rolled over 1.4 versus 2.5, but they've still maintained 25%. That's the power of that leverage. So the equity value of the business is now $5.7 million, not 10, because it's been diluted. And the debt increases the cash at close by over $1 million. Very powerful, very, very powerful. And in this business, it doesn't appear to be overly burdened by debt. And they might bring it in the form of mezzanine, potentially, mezzanine debt, which doesn't actually get paid off along the way, perhaps only the interest, and there's a balloon payment at the end, in which case they might refinance, or perhaps 5 years from now, there's a second transaction. So there's still money in the business being generated by the business to grow. So it's a pretty interesting and useful approach here that doesn't dilute you. It only dilutes the buyer if it's done appropriately. We've also seen deals where the buyer brings debt, puts it on the balance sheet, and doesn't want it to serve as dilution for them. And that's where you need to have somebody who knows what they're doing, that does this every single day, to fight for you, to ensure that the dilution only happens to the buyer and not to the buyer and the seller. Okay, so we talked about how complicated private equity math is, and there's a few other just a little points that I want to get to toward the end here that aren't overall themes, but just other considerations. You might be in a business that is a manufacturing business with a heavy piece of equipment, and that might be the primary mechanism to drive earnings for the business, right? And let's just say your business does $750,000 in EBITDA, and it's fairly predictable, but that machine requires $500,000 each year in upkeep just to maintain. So in order to maintain that EBITDA level, you actually have to throw $500,000 a year into this machine to keep it going. Most buyers, and certainly all private equity buyers, will look at your business not as a $750,000 EBITDA business, but more like a $250,000 earnings business. They would use CapEx as an inhibitor to cash flow, and it's predictable, right? They're just trying to map out predictability of cash flow. They might even incorporate changes in working capital. So the value you see in that deal will likely be off of 250 and not 750. Again, it's important that you have a capable advisor in your corner, because a good advisor will be able to identify what is CapEx and what is not. What's above the line, what's below the line, what lives in the balance sheet, what should live on the income statement. These are important considerations, and you really want to have somebody who does this every day on your side. The other thing we see from buyers is they're driving value through complicated formulas. They might be looking at a discounted cash flow that spits out a number, and they know perhaps that you want a very large multiple. Let's just say they know you want 8 times, and they know that their valuation spit out $8 million. Well, they need to get your EBITDA down to $1 million. If you're at $1.4 million, they've got to find a way to erode EBITDA, because they want to show you that multiple, right? So that they will game the system by attacking your add backs to inflate the multiple. Not all of them, but we've seen it quite a bit, and it's important to keep in mind, because that multiple really isn't the most important thing for most sellers. For most sellers, it's about the proceeds. But some really want to get locked in on a high multiple, above market multiple. So be on the lookout for that. Again, having somebody on your side that can really identify this is absolutely key. Another reason to have somebody on your side, this is a bit of a theme. So if you're approached by a private equity fund, many of you have, perhaps you've spent some time with them, brought them in, done a site visit, showed them some of the financials of the business, hopefully gotten an NDA in place, I hope. You might even get an offer. How do you know that offer is competitive? You don't, right? You can go and look at some of the online resources. There are plenty. Unfortunately, if you were to do a deal, you're not going to release the financials behind it. You're not going to release the multiple. You certainly won't release to the public what you were paid. And buyers are actually even more reticent to do so. Buyers don't want to say they paid 8 times for a business. That'll set the floor for the next one, because sellers will see that they're paying 8 times for businesses and want more. So that those kinds of comps are just not readily accessible. What is accessible is public comps. The problem with public comps is that they're inflated as it relates to private companies. There's a liquidity discount and there's a size discount. Something that's a $1 billion transaction that does $100 million in EBITDA is in no way similar, because of the scale they bring, the economies of scale and scope that they bring, to a business that does $1.5 million in EBITDA. They're very different businesses, and you really can't apply those multiples. So what else can you do? Well, you can do a bit of a test. You can go into your industry and figure out who's buying. Maybe there's a buyer out there that's buying a number of businesses in your space. Perhaps there's a roll-up happening. You can certainly call that buyer as well. Maybe engage them. Maybe get a second potential offer. Right? So you can test the market. The best way to test the market is to engage somebody. You have a unique collection of assets. Your business is not a perfect substitute for someone who does what you do. It just isn't. They're very different. There are reasons why your business is more attractive to some buyers than others. The same with your competitors, right? Might be a better fit. The best way to determine the value of a collection of assets like a living, breathing, functioning business is to take it to market and see what the market will bear. So we always advise folks even considering doing a transaction, even folks that don't work with us, we advise them to engage someone to take them to market. And that's the best way to determine what your business is worth. So I'd encourage you to do that. Okay, so let's just say you're able to get your business under letter of intent with a buyer. That's when the fun really begins. And I say that facetiously. So due diligence tends to not be very fun. But it's unavoidable. Every deal, even the smallest of deals, require a meaningful amount of due diligence. What's happened in the last several years, probably the last 10 or so, is some of the methodologies used in large deals, even billion-dollar deals 10 years ago, we're now starting to see them in these small deals, right? So buyers weren't doing quality of earnings 10 and 15 years ago on $5 million deals. Too expensive. They would just send their own team there on site, perhaps collect what they can from QuickBook files and put together their view on the earnings and the revenue. Not anymore. Even in smaller deals, they're engaging perhaps regional or local firms, accounting firms, to do a quality of earnings. And they can do them for under $25,000 these days for smaller deals. So we're starting to see some of these complex diligence approaches creep down into the lower middle market. So it can be pretty burdensome if you haven't experienced it and you don't have help. Buyers also expect on-site visits. This is something that is a recurring theme. They'll want to be on site. They want to meet your customers, or they want to meet your employees. They're going to want to see it, feel it, touch it. And the quality of earnings team will probably also need to be on site for at least a day. So there's going to be visits. They're going to want to speak to your employees, especially your key employees. The timing is really important there. Your instincts are going to tell you this is a terrible idea. You don't want these guys knocking on doors and introducing themselves to your key employees or talking to customers, because your instinct says it can be disruptive. And your instinct is right. It can be disruptive if it's not couched appropriately and if it happens at the wrong part of the process. That's why it's so imperative to have somebody who knows what they're doing on your side. Okay, so at Benchmark, we have a track record of identifying the perfect time to have these really difficult conversations. And what's really important to do is to set expectations at the very front end of the process. So that's when you're discussing the LOI with the buyer prior to execution. It's really important to set that expectation. We would identify these kinds of calls to customers and these kinds of meetings with key employees, any employees, employee interviews, to be operational, almost confirmatory due diligence that happens at the very end of the process. So what's a good landmark, a good benchmark on when you should consider opening up sort of the books a bit here and letting them behind the curtain? We tend to see the first turn of a purchase agreement. So when the buyer's attorney drafts the first draft of the purchase agreement, that's a very expensive document for them. They've spent maybe $15,000, $20,000 creating that, and it really shows that they're pretty serious about doing a deal. It also will allow you to understand how close are we. If it's a very impressive document, you might have less confidence than if it's a very sort of seller-friendly, middle-of-the-road document. Your attorney will help you understand that. So it's a really good barometer as to when you should start opening up the doors, and you may only have 3 or 4 weeks of diligence remaining at that point. So that tends to be what we advise. Buyers will like to sequence how they do their diligence. So they'll start with the quality of earnings. It's a 25 to, depends on the size of the deal, even up to $250,000 check that they have to write at the very front end. But if the numbers do not come back in even close to what they had thought they'd be, they may not want to continue with diligence. So they tend to put that at the very front of diligence, but oftentimes they'll wait until that's done to really start spending additional money. We like to push them into more of a parallel path approach. We want them spending money from the get-go. That creates commitment. It creates stickiness. Once they're invested, even though they probably shouldn't look at it this way, they tend to be more pot committed. And when they're spending money, it's generally good for sellers. So we push for parallel path. They tend to push for sequential, and we often will meet in the middle. So that's a really important consideration as well. We talked about this very, very early in our discussion here, that buyers are looking for specific reports, and sellers just aren't often able to provide those reports. So during diligence, there'll be questions that no one could have anticipated. They'll get an answer to a question and it'll lead to 3 other questions, right? And if you set that expectation at the very front end and that due diligence kickoff call, where if you have questions that we're not able to answer with reports, let's schedule a call. It's so important. It's really our path. We always put together issues lists along the way to make sure that we can all get on the same page. Really important to do that during diligence, and the best way to do it is to have someone on your side. Okay, takeaways. We're wrapping up here. The private equity world is a lot of myths surrounding private equity, and there's a lot of folks who have sort of a bad taste in their mouth, even though they haven't interacted with these guys. But it's really a mistake to ignore them. They're a tremendous source of funding. They can get your deal done. The biggest risk to getting a deal done, other than time, is lack of funding. So you really want to consider them, whether you do a deal with them or not. They're also incentivized to grow, right? This is their buy-in price. For them to make money the way they're compensated, they have to grow it. If you roll over equity, you are aligned, right? You have a chance perhaps to have your second bite of the apple, right? When they sell it 5 or 7 years later, be meaningfully larger than your first. So you get the chance to de-risk a bit, take some chips off the table, and trust it to someone who cares about it, partially yourself, but also get a second payday down the road. So it's in some ways the best of both worlds. We talked about the sort of the big gap between what sellers are rarely able to produce and what buyers expect in the private equity world, and some of that as it relates to data and diligence and how to bridge those gaps. The gap is just inherent in the lower middle market. It just exists, and there's really no way to eliminate the gap. All you can do is bridge it, and it's one of the reasons you see a lot of broken deals in the lower middle market. Even when private equity funds are there, when you eliminate the risk of funding, this is a major source of broken deals. It's really important, and I've said it probably 12 times, but let's go for lucky number 13. It's really important you have someone on your side advising you, fighting for you, having difficult conversations, folks who understand how networking capital works, understand how dilution should impact the buyer and not the seller. So if you have any questions, please do consult with a local Benchmark International representative. Give us a call. Happy to have a conversation. And at this point, I think I'll just turn it over to questions.
Awesome. Yeah, we've got a few questions here. First question, will private equity always ask me to retain a part of the business? And a follow-up to that one, why do they want me to own after I sell?
Got it. So they won't always ask you to retain a part of the business. It is a very predominant structure. Buyers like to see rollover equity for a couple reasons. One is it really confirms their due diligence. They want to make sure that they made the right decision in the first place, that they didn't miss something, and a seller being willing to stay on after the sale and continue to own the business is really good confirmation of the work that they've done during due diligence. Perhaps more importantly, they want the seller to act like an owner after he sold the business, after he or she has sold the business. And the best way to make someone act like an owner is to make them an owner. So those are really the two predominant reasons to ensure that the diligence they were right on their diligence, that they've done the appropriate work, as much work as they do in due diligence. They can't see everything. And perhaps even more importantly, to ensure that the key people, especially the lead dog, is still incentivized and acting like an owner.
Awesome. Good. Next question here. So they always use debt to buy companies, kind of a question mark there. Don't they raise funds? So I don't understand why they use debt. I think is the main thing here. And I know you talked about some, but maybe elaborate a little
Sure, absolutely. Yeah, so they do have pools of capital. They raise equity capital. So the way it works is they go to a series of folks who have deep pockets, insurance companies, endowments at universities, banks, and they put together, even wealthy individuals, and put together a big fund. And they use that to buy companies. The rate of return that their investors require is something generally in the 20% range, right? So they've got to be very, very successful, right, in their investments to hit that bar. So their cost of equity capital is around 20%. Debt is cheap right now, historically cheap. 5, 6, 7%. Because of that, they want to use that debt as a lever, right? They can do a deal if it's 50-50 debt and equity. They use half the amount of equity they require to buy the company. It allows them to do twice the amount of deals. So, and especially in this environment where debt is so cheap, it's not as burdensome on the business. You can still grow it. It just makes a lot of sense.
Another question kind of on that same topic. How does a private equity group make it known that they are well-funded or has access to the funding?
Good question. So there are a lot of resources out there where you can go and actually view how much dry powder they have. So they will always release a press release when they've closed a new fund. So you just Google their information. You'll find out that they raised a fund 3 years ago, and there are resources that will tell you how much dry powder is left. These funds have 10-year lives. They tend to deploy capital over the first 5 or 7 years, sometimes less, so you can infer as well. But there's a lot of publicly available information. And if you have an advisor, they have access to unique places that we use PitchBook, we've used Capital IQ, that will actually provide in detail all of their investments, how much dry powder they have left, their average deal size, the average equity check they've written. And also, frankly, really quality private equity funds will publish this information. So you'll see on their site the kind of deals they do. You may even see, when they raise their last fund, and you can infer from there also how much they have left. So there's a lot of information out there that you can get, and then your advisor can get quite a bit more.
Awesome. A couple here on due diligence. So how is due diligence with a private equity group different than it is with, say, like a competitor?
Got it. Yeah, it's a good question. So a private equity fund is going to be very much focused on the financial piece of it, for sure. And I think a strategic will also be looking at that, but also be looking at sort of, will these cultures work, right? Can we get on board with allowing this team to continue with their rules and procedures and processes and their culture, because they do the same thing. They're going to be looking to see if there's cannibalization, right? So if you're in the same industry, you don't want to buy a competitor and have this business that you're buying cannibalize from your existing sales, right? You're trying to create a situation where 1 + 1 = 3, and you don't want to create a situation where 1 + 1 = 1.5. So there's a different approach to diligence, because a private equity fund might be looking at this as a platform acquisition where they're going to add 4 or 5 add-ons to it, right, to really grow it. Whereas a strategic is going to look to either get into a new market or take out a competitor.
And then another question kind of in line with that, about how long does due diligence take? And I think a good thing to add to this is how much of the process is complete at the time you enter into the due diligence stage.
Okay, another good question. So diligence can take anywhere from 60 to 120 days and more, but I would say that's probably the predominant sort of, it's not an average, but that's probably the range we see more than anything. And it tends to map to exclusivity in an LOI. So we tend to see 90 days as a good, 90 to 120 days is probably the most often, but we do see deals sometimes go in the 60-day range. So some very high level diligence is done prior to offering an LOI. Generally, they've received the SIM that we've created, the confidential information memorandum, perhaps had some data requests fulfilled, had a call with us, had multiple calls with the seller, and likely have had a site visit and to really kick the tires a bit, but they have not taken a deep dive. They're relying on the information they've been provided and their industry research that they've done. So there's a lot of diligence that's done after the signing of the LOI. I'd say 90% of it is still to come.
Awesome. And then I think the last question here, about how much cash typically goes to the seller as a % of valuation. I think this one stemmed from the examples that you just put out.
Sure. Yeah, that's a tough one to answer, because it's each deal is really a unique thing. If it's less than 50%, I would say it's probably not market, but the kinds of structures they're using would really detail kind of why they're going in that direction. So if you see something where they're going to pay you 40% cash at close, they want a big rollover piece and there's an earnout, I think what they're telling you is that you're growing. I don't know that I believe that it's sustainable, and we're going to make sure that a piece of it is kind of contingent upon future success. So, I would say on average, you see 50 to 75% cash at close. Sometimes you see even higher. We've done 100% cash deals. They don't happen often. You know, the higher the cash at close, the lower the overall valuation generally. If you want a buyer to stretch to a really high multiple, they're going to put a piece of that in an earnout, a piece of that in a seller note, and probably a piece of that in rollover equity. So you really need to determine whether you want more cash today, where you want a higher valuation, headline versus cash today.
And then I had just one more question that
Yeah.
just came in. How long does it typically take to prepare a selling company to be in a good position to engage in conversations with private equity opportunities? Great question there.
It is a good question. And, you know, I learned, I think my first day of my MBA, not as fancy of a school as some of these buyers, but the answer to almost every question by an MBA is it depends. So we don't tend to spend a year and a half with our clients before we take them to market. We just don't view that as being necessarily constructive to getting a deal done. You know, buyers like to see that they can actually add some value. So if we spend a lot of time grooming our clients and getting them perfect, most buyers will look at it and say, what angle, what value do I bring? How do I make this actually more valuable in my hands than in the seller's hands? So, you know, oftentimes it's just a 6-week to 6-month process, getting the financials in a position where they're presentable, detailing all the add backs, doing that sort of scrub internally to spread the financials and to really get that story down. We don't take a lot of time on the front end. We don't think it's very valuable, frankly, to do a tremendous scrub on the front end. So, you know, 6 weeks to 6 months.
I think that's good. That's all the questions that I had.
Great. You know, I really appreciate the opportunity to talk a bit about private equity and how it's actually something you should consider. But if you do consider it, please do engage with someone who knows what they're doing, and we'd love to get a call from you. Please feel free to reach out to me with any questions. My information is accessible on our website, and I look forward to hopefully speaking with some of you.